Your bank is watching every dollar that moves through your account. Not occasionally. Not randomly. Every single transaction. Every deposit. Every withdrawal. Every transfer. All of it flowing through automated systems that are specifically designed to identify patterns that trigger a report to the federal government. And most Americans, including millions of seniors who have spent decades managing their own money responsibly, have no idea how close they are to those triggers on a regular basis. The number most people have heard is $10,000. Deposit more than $10,000 in cash and your bank files a report. That much is widely known. What is not widely known, and what is quietly catching ordinary Americans off guard in 2026, is everything else. The transactions below $10,000 that still trigger reporting. The completely legal behavior that the federal government classifies as a criminal act. The automated monitoring systems that have expanded significantly in the past several years. And the specific patterns that seniors engage in completely innocently. Withdrawing cash for home repairs, depositing savings kept at home, moving money between accounts, that are generating federal reports without a single phone call to the account holder. This is not about people trying to hide anything. This is about people who have no idea the rules exist, and who are walking into situations that can range from an account hold that lasts 2 weeks to a federal investigation that starts with a letter and ends in court. The law has been in place for over 50 years. But the technology enforcing it has changed completely. And the gap between what most Americans understand about their own bank accounts and what their bank is required to report has never been wider. The foundation of everything that happens when cash moves through your bank account is a 1970 federal law called the Bank Secrecy Act. Congress passed it to prevent criminals from using financial institutions to launder money and hide illegal proceeds. The mechanism it created was straightforward: require banks to file reports whenever a cash transaction exceeds a specific threshold, giving the government a paper trail to follow. That threshold was set at $10,000. And under the Bank Secrecy Act as it stands today, every bank, credit union, and financial institution in the United States is legally required to file what is called a Currency Transaction Report, a CTR, with the Financial Crimes Enforcement Network, known as FinCEN, anytime a customer conducts a cash transaction exceeding $10,000 in a single business day. According to U.S. News and World Report's February 2026 update on this topic, the $10,000 threshold applies to both deposits and withdrawals. It applies to physical cash, bills and coins. It includes foreign currency and certain monetary instruments like cashier's checks and money orders when used in cash transactions. And critically, it includes the total of multiple transactions in a single day. If you deposit $6,000 in the morning and $5,000 in the afternoon at the same bank, the combined total of $11,000 triggers the same report as a single $11,000 deposit. The CTR itself is not an accusation. It is not a flag for an audit. It is a routine administrative report that the bank files automatically, in 2026, almost entirely through automated software, and it captures your name, your social security number, your account number, and the amount and nature of the transaction. Most people who trigger a CTR never know it happened. There is no requirement for the bank to notify you. The report goes to FinCEN. FinCEN shares information with the IRS, the Department of Justice, and other federal agencies when patterns suggest further investigation is warranted. A single CTR on a legitimate transaction typically produces no consequence. But it creates a record. And that record becomes relevant if other activity on your account draws attention later. Here is where the situation becomes genuinely serious for people who think they are avoiding scrutiny by staying below $10,000. There is a federal crime called structuring. Structuring is defined as deliberately breaking up cash transactions into smaller amounts specifically to avoid triggering the $10,000 reporting threshold. You do not need to be moving drug money. You do not need to be evading taxes. You do not need any illegal intent beyond the specific intent to stay under the reporting limit. As Ralph Law Group stated directly in their October 2025 legal guidance on this topic, structuring is a federal crime even when the money itself comes entirely from legitimate sources. The act of deliberately keeping transactions below $10,000 to avoid the CTR filing requirement is the crime, regardless of where the money came from. The penalties are severe. Structuring carries a maximum federal sentence of 5 years in prison. Assets associated with the structuring activity are subject to civil forfeiture. meaning the government can seize the money without a criminal conviction, simply by demonstrating that the transaction pattern was designed to avoid reporting. According to IRS data cited in published legal guidance, in 2016 alone, $43 million was seized from over 600 depositors under suspicion of structuring. Many of those individuals were small business owners, retirees, and ordinary Americans who were keeping deposits below $10,000 because they thought it was simpler, or because someone told them that was how you avoid bank paperwork. They had no idea the behavior they were engaging in had a federal crime name attached to it. The pattern that triggers structuring suspicion is consistent and documented. Making multiple cash deposits in amounts just under $10,000, $9,500 here, $9,800 there, within a short time period. Making repeated deposits of similar round amounts. Spreading deposits across multiple branches of the same bank. Spreading deposits across multiple banks. The bank's automated monitoring systems in 2026 are specifically programmed to recognize these patterns across your entire account history, not just within a single day. U.S. News confirmed in their February 2026 reporting that if an individual makes cash deposits over several days that are less than but still add up to at least $10,000, that person will be reported, and this applies even when deposits are spread across more than one bank. Beyond structuring, there is a second category of reporting that most Americans have never heard of, and that directly affects seniors who conduct certain kinds of transactions during retirement. It is called a Suspicious Activity Report, known as a SAR. While the CTR is triggered automatically by the dollar amount of a transaction, a SAR is filed at the bank's discretion when a transaction, regardless of its size, appears unusual or suspicious based on the account's history and the customer's known financial profile. Banks are required under the Bank Secrecy Act to file SARs for transactions that involve funds from illegal activity that are designed to evade reporting requirements, or that have no apparent lawful purpose given what the bank knows about the customer. In practice, what this means is that a transaction of $3,000 can generate a federal report if it looks unusual given your account's normal pattern. A sudden large withdrawal from an account that normally maintains a stable balance. A series of cash withdrawals from an account that previously had very little cash activity. A deposit from a new or unfamiliar source. A wire transfer to an account the bank does not recognize. For seniors specifically, the SAR reporting system has created a situation that is genuinely difficult to navigate, because the transactions that trigger SAR filings frequently align with normal life events during retirement. Withdrawing a large sum of cash to pay a contractor for home repairs, common among homeowners who prefer cash transactions for service work, can trigger a SAR, particularly if the amount is significant or if the bank system flags the withdrawal as inconsistent with the account holder's normal behavior. Depositing savings that were kept in cash at home, money tucked away over years that a senior decides to move into the bank, can trigger both a CTR if the amount exceeds $10,000 and a SAR if the deposit appears inconsistent with the account's history, even if the money is entirely legitimate. Moving money between your own accounts at different institutions can trigger SAR filings if the wire amounts or timing patterns appear unusual. Receiving a lump sum payment, an inheritance, proceeds from a property sale, a life insurance payout, can generate scrutiny if the amount and source do not align with what the bank expects based on your financial profile. None of these transactions are illegal. Every one of them is a situation that ordinary, honest Americans encounter during the normal course of financial life. But all of them can generate a federal report that sits in a government database, and that becomes part of a pattern that may trigger follow-up attention if other activity on your account is flagged later. There is also a relatively new layer of monitoring that was reinforced in early 2026 and that expands the visibility government agencies have into cash transactions below the $10,000 threshold. According to reporting from December 2025, updated Treasury and FinCEN guidance effective into 2026 requires banks and certain businesses to report in greater detail on cash transactions between $1,000 and $10,000 in specific circumstances. This does not mean every transaction in that range generates an automatic report. It means that financial institutions operating in certain higher risk categories, money service businesses, certain dealers in high-value goods, real estate transactions, face expanded reporting obligations that pull a broader range of cash activity into federal visibility. For seniors who conduct business with these types of entities, purchasing jewelry or collectibles, engaging in certain real estate transactions, using money service businesses to wire funds to family members, the dollar amount that generates documentation has effectively moved downward in specific contexts. The IRS has also confirmed that businesses receiving more than $10,000 in cash for goods or services are required to file Form 8300 within 15 days of the transaction. This requirement exists alongside the bank's CTR obligations, meaning a single transaction can generate two separate federal reports from two different sources. If you pay a contractor $12,000 in cash for a home renovation, the contractor is required to file Form 8300 with the IRS. If you withdrew that cash from your bank, the bank may have filed a CTR. The same transaction appears in two separate federal filings, from two independent sources, creating a corroborating record that neither filing alone would create. The penalty for a business that fails to file Form 8300 is $100 per infraction. But for the customer whose transaction generated the filing requirement, the documentation creates a paper trail that connects specific cash withdrawals to specific expenditures. Exactly the kind of documentation that makes a subsequent audit more comprehensive. The practical guidance that financial and legal professionals consistently give to clients navigating these rules comes down to a set of principles that are straightforward once you understand why they matter. The first and most important principle is transparency. When you have a legitimate large cash transaction, a significant deposit, a substantial withdrawal, a major purchase, allow the process to work as designed. Deposit the full amount at once. Do not break it into smaller transactions across multiple days or multiple banks. As legal guidance from Guardian Tax Law confirmed in June 2025, making one large consistent deposit is actually less suspicious than making multiple smaller deposits that could look like structuring. The CTR that gets filed on a single large legitimate transaction is a routine administrative form. The pattern of multiple smaller transactions that collectively add up to a large amount is a federal crime flag. The second principle is documentation. Keep records of the source of any significant cash you deposit. If you are depositing savings kept at home, have a written record of when and where that money accumulated. If you are depositing proceeds from selling a vehicle or a valuable item, keep the bill of sale. If you received a gift, inheritance, or insurance payout, retain the paperwork that documents it. The IRS is not entitled to seize money simply because it was deposited, but if a transaction generates scrutiny, documentation of the legitimate source is what resolves that scrutiny quickly. The third principle involves understanding what does and does not trigger reporting. Personal checks and wire transfers over $10,000 generally do not trigger a CTR, because they already have a digital paper trail that serves the same purpose as the report. The $10,000 reporting rule is specifically targeted at physical currency. If you are moving large amounts of money between your own accounts or making significant purchases, doing so through check or wire transfer rather than physical cash eliminates the CTR filing requirement entirely, while creating documentation of the transaction that is equally or more useful if questions arise later. The fourth principle is communication. If you know a large or unusual cash transaction is coming, a significant withdrawal to pay for a home repair, a large deposit from selling a property, call your bank in advance and explain what is coming. Ask them to note the explanation in your account file. This does not eliminate the reporting requirement, but it creates a contemporaneous record in your account history that the transaction was anticipated, explained, and consistent with a legitimate purpose, which significantly reduces the likelihood that an automated SAR filing follows. Here is the reality behind all of this that most financial news coverage avoids stating plainly. The Bank Secrecy Act reporting system was built to catch criminals. It is run by automated software that cannot distinguish between a retired teacher depositing 50 years of accumulated savings and someone laundering drug proceeds. The software looks at patterns. It flags anomalies. It generates reports. And then the reports sit in a database that human beings review. Eventually, if something else about an account draws additional attention, the vast majority of people who trigger CTRs or SARs through completely legitimate transactions face no consequence beyond the filing of the report. A CTR on a single large deposit from an identifiable legitimate source typically produces nothing. A consistent pattern of keeping deposits just below $10,000, even with entirely clean money, produces a federal criminal investigation. The difference between those two outcomes is not the amount of money. It is whether the behavior looks like someone who understands the rules and is following them, or someone who understands the rules and is trying to avoid them. For seniors managing retirement savings, real estate transactions, home repair payments, inheritance distributions, and the financial complexity that comes with decades of accumulated assets, The rules that govern how that money moves through the banking system matter more than most people realize. Understanding them is not about being afraid of your own bank. It is about making sure that the financial decisions you make every day, decisions you have every legal right to make, do not generate a paper trail that looks like something it is not. The IRS is not investigating every person who deposits more than $10,000. But the system that sends them the information to investigate someone if they decide to look is running automatically, around the clock, on every transaction in every account at every bank in the United States. Now you know exactly how it works. This video is for educational and informational purposes only and does not constitute financial, tax, legal, or banking advice of any kind. All information is sourced from publicly available federal law, IRS guidance, FinCEN regulations, and published financial reporting current as of 2026, including U.S. News, Ralph Law Group, Guardian Tax Law, and official IRS.gov publications. Individual circumstances vary. Always consult a licensed CPA, tax attorney, or financial advisor before making decisions about large cash transactions. Federal Decoded is not affiliated with the IRS, FinCEN, or any government agency.